Well, good evening, everybody, and thank you for so much for joining us for tonight's webinar all around cattle. And so tonight we've brought a wide variety of experts from across the industry to join together and provide you with insights that are hopefully pretty actionable for your farming operation. As a quick reminder, all attendees are muted and videos are shut off. However, we'd love for you to engage with our presenters this evening. And so if you are joining from a mobile device, feel free to select those three buttons at the bottom of your WebEx app for chat. Or if you are joining from a desktop, you can find that chat feature in the bottom right corner. We'd love for you to engage with our presenters through asking questions, and we'll go ahead and answer those all on the back end. Before I begin, I'd like to introduce my friends here on the call. The very first is going to take us away is going to be Mary with CattleFax. Mary is an analyst and spends a lot of her time helping producers manage their risk through insights that her and her team work to provide producers all across the country. We also have Kirk Hinz with BAMWX Weather. Is going to provide us some perspective on what's going on from a weather piece. And then Austin is going to close us out, who is our livestock product specialist at Farm Credit Mid-America, with how do you manage some of these risks that Kirk and Mary are going to talk about actually on the farm and ranch. And so with that, Mary, I'll turn it over to you. And thank you all so much for joining us this evening.
Great. Thanks, Micah. Just to make sure, can you see my screen? Yes. Okay.
We sure can.
Okay. Yes. So I'm going to run through a cattle market outlook, but to start off, I'm going to go into feed and grains just for a little bit. So as we look towards this next year and the supply situation for corn, we're in a pretty comfortable stocks to use. So these bars are showing the supply of corn, and then the line here is the price. And so you can see that compared to historical levels, the stocks to use is at a pretty comfortable position, and we're expecting record yields given the crop conditions that we've seen. So with that, we should continue to see lower corn prices, with an average price expected to be around $4.30 a bushel for this marketing year, but risk higher than that, of course, and there's going to be some trading lower than that as we've seen lately. So that's just kind of a range around what we expect with the corn. Let's see. Just 1 second. Sorry, Micah, my screen doesn't want to move for me. We're a little stuck here. Okay, maybe now it's going. Okay. Sorry, that was weird. So then looking at the hay, so we can see that last year in 2022, 2023, we were in a declining hay supply. Kirk will go through the weather a lot better than I will, but you can see that we got to a pretty depleted hay state, but we really rebuilt the stocks there as we look at where hay was to start May. And so with that, we ought to be in a pretty comfortable feed and grain supply as we look into the next year. And that ought to be a lot of relief from what we've seen in previous years to the prices. I'm sorry, I'm still having trouble getting this. Okay, maybe now. Okay. Wait, did it stop sharing? It stopped.
Mary, I'm not able to see your screen.
Sorry about that. Okay. And now you can, yes?
Yes.
Sorry. I'm not sure what is going on here. Okay. Okay, so all that to say that we're at a lower price point as we look at grains and feed, and then hay as well, than what we saw throughout 2021, 2022, first part of 2023. But at the same time, as Kirk's going to go through, we do have some risk moving forward for these grain prices, and you can just see all the volatility that there is just when we think of the last few years, and if you all just remember back in the last few years. So with that, just a lot of volatility there, but we are in more comfortable levels as we look at this year. But as Kirk's going to go through, and as you all know, we did get out of the drought for the most part, but not fully out, not to where we got to a really good condition for all the pastures and grazing. So as we think ahead, and as we probably do move into more of a drier pattern up ahead, it's good to remember this, and then also to look to protect your risk there. And Austin will go through that, and so will Kirk, with the different rainfall insurance and things that you can do within the feed cost risk, because just the amount of volatility that we can see within that, given where the supply could be in the next few years, it's just important to manage that as we look ahead. But moving more towards the cattle and the beef side, hopefully. So before we get into the cattle supplies and prices there, we're going to look at the beef demand that we're seeing. So we've seen record high retail prices, and overall the retail beef demand has been really strong. So you can see here in the top chart, prices reached new highs and are on track to average of $8 a pound. We don't have them a lot higher in 2025, but still seeing a lot of strength there. And if you look at beef relative to competing proteins, so this bottom right chart here is comparing beef to the ground beef to the chicken breast and the boneless pork chop, which are reasonable substitutes to look at. You can look that they've gotten a little stretched compared to their historical relationship, where ground beef has gotten more expensive relative to the competing proteins. So as we think, that's a signal of good demand that we've seen, but it also acts as a risk as you think ahead of where consumers might need to cut back spending if we were to enter into a recession. But with the interest rate drops, we've seen a little bit of improvement there on that side, and we've seen slower inflation. So ultimately what this is showing is that beef has really held on to really strong demand. So record high demand here as we look at the summer retail beef demand. And while we expect that it'll be measurably softer next year, we expect higher prices on that side, but with the tighter supply, that would equal weaker demand, because this demand is a function of overall supplies, and then the price gets you to demand. So far we've been maintaining that demand, and we expect it to remain strong, but it'll probably be not quite as strong next year as we do consider tighter supplies and just a more stretched consumer, especially with the lower competing protein prices. One other part of this demand is the food service and restaurants. So the Restaurant Performance Index is filled out by restaurants and restaurant managers, and it shows kind of if we're in an expansion or contraction, and it's all kind of relative to 100. So if we're below 100, then we are considered in a contraction mode. And you can see that we're at the lowest part, aside from COVID, that we've been in since the previous recession, so since the global financial crisis. It's not to say that we're in a recession now, but that is to say that there's some risk there as we look at the food service and restaurant demand. And if we look at where that weakness is coming from, this top chart is an average of these bottom two, so the expectation in the current situation. The current situation has been lower, and so the components of that are the traffic and the same-store sales here in this bottom right chart. So this is a lot in one chart or in one page, but you can see that the same-store sales and the customer traffic is really what's brought the average down of that index, and is where restaurants are struggling. Is that not only are consumers coming through the door less, now they're cutting back their spending when they do go in. So that is a risk to demand as we think ahead, but so far the beef demand as a whole has held together really well. And all of that is just what puts money into the system in general, so that it gets passed back to the cutout and then back to the producers. And so we'll get into the cattle market outlook, but first we'll look into the supply here. And so as we look, we've got the smallest beef cow herd on record this year, and then we've got another decline expected for next year. And so we have seen a lot less culling. We've seen a lot of recovery as far as people are keeping more of their beef cows. They're not culling nearly as heavily because of improved drought conditions, but we didn't retain as many heifers. And so as we look at heifers as a percent of the beef replacement heifers as a percent of all heifers, you can see that that is still at a historically low percentage there, and nowhere near the expansion levels that we saw back in the previous cycle or in the 90s or even back in the 2000s in that cycle where we had a slower increase. So one more thing I wanted to point out within this beef cow inventory is you can see in the last cycle that as we worked down, in 2014 we reached the low. We saw a slow increase in 2015, but then it was about 2 years of back-to-back 1 million head increases or near it for the beef cow inventory. We don't expect this cow cycle to look like that. As you can see, 2025 shows a small increase and then another pretty small increase in 2027. Or no, 2026 shows a small increase, but then it's another pretty small increase as we look at 2027 as well. And so a lot of that is going back to the drought that we're seeing and also just the economics and the industry as a whole with the aging producer and just kind of a different landscape here. But generally, we do expect to see some expansion, just at a lot slower pace than that previous cycle would have shown. And we're just going to go through some of these things pretty quick, but some indicators are starting to show some heifer retention. You can see that heifers as a percent of fed slaughter has started to move lower throughout the year, but is still generally high compared to that 5-year average. And heifers as a percent on feed here in this bottom left chart is still really elevated to see a lot of retention. So we're still not at a point where we've seen retention in a big way, and that is part of what's going to lead to that slower rebuild to the cow herd. And placements have started to move lower for heifers, but still above that 5-year average. And if you think of the last 5 years, we haven't seen expansion to the herd in the last 5 years, really. So we're still not at an expansion pace as the lower end of this 20-year range would be. But as I said, beef cow slaughter has come down a lot. So far, we're tracking 16% below a year ago. Seasonally, we will still see some increases as we look at the fourth quarter. That's where we tend to see more culling. But you can see that the culling rate has come down quite a bit, but it's still above this 10% level. And we say that it's really got to be below that 10% to see expansion at a meaningful pace. So we did start from a smaller base. So with that smaller base, even though that slaughter is down, culling rate is still at a percent that we would say more at stabilization rather than expansion. But as a whole, dairy cow slaughter is down as well. So that commercial cow slaughter is looking to be down 900,000 head this year. And then another decline is expected as we look at next year. At the same time, steer and heifer slaughter has been pretty strong this year. I mean, it's down a little bit for this year, down 200,000 head. But as we look, we expect to see another big decline next year. So last year, we were down over 1 million head. This year, we're almost steady. But then next year, looking at another 900,000 head decline because the calf crops have continued to be smaller. And we've continued to just see, like I said, a lack of retention and a lack of growth there. So expect for slaughter to be down more next year, but this year is held fairly steady there. And then whenever you consider the increase that we've seen to these weights, weights are looking to be over 20 pounds higher than year-ago levels and continue higher than next year. Part of that is that the slaughter mix is going to be more steers than heifers and cows. And part of that has just been maximizing the days on feed. Like we looked at, corn is a lot cheaper. And so it just makes sense to really maximize the cattle that are on feed. So as a whole, that puts beef production down just a bit this year, 1.2%, a lot of that being the loss to the cow herd rather than the fed side. Looking at 2025 is where we expect to see a 1 billion pound decrease, looking to be down 3.5% with a decline both to cows and the fed slaughter. So tighter supply all around as we look ahead. But if we look on feed and what you might hear around the industry is that cattle on feed is up just a bit. So the last 3 months have been up about 1% compared to a year ago. Part of this is that there's more days on feed. So the slower turnover rate does keep more cattle on feed. So even though they're on feed, it doesn't mean they're necessarily available for slaughter. But we are seeing cattle on feed generally small when you compare to the 5-year average, and expect to continue to see that as we move ahead, or it might hold more steady out of the fact that they're being put on feed for longer, but still generally fewer cattle available. And we really expect to start to see that here in the fourth quarter. So you can see year to date, slaughter has held really strong, and even through September, slaughter came in stronger than what we probably would have expected. But as we look at the fourth quarter, and as we just look at the daily action and the weekly action within slaughter, we are starting to see kills being cut a little bit. And with tighter supplies available in the fourth quarter, we expect that fed slaughter is going to average about 14,000 head a week below year ago as we look at that fourth quarter. And then another decline as we look ahead into the first quarter of next year. If we look at prices, we've seen prices hold together pretty strong. But if we think about the Fed steer price in general, as we look at the past few years, we saw a $30 a hundredweight increase from 2022 to 2023. This year, we're looking to track another $10 a hundredweight higher than 2023. But then as we look at 2025, we're expecting just another $5 a hundredweight increase and just a more range-bound market. So maybe just trading between that $1.75 to $2, or whatever you want to, whatever your range is. We expect it to be in that $1.75 to $2 range, but generally just more range-bound sideways. Still got some seasonal trends to it, but it's just been more of a steady market than the explosive increase we saw in 2022 and 2023. And that's even with the tighter supply that we expect next year. And so far, that's held true. But as that passes down, I mean, that's still historically high prices as we think about the fed cattle. And as we look ahead as we look down the chain towards feeder cattle and calves, we're looking at historically tight outside supplies. So feeder cattle and calf availability is at historically low levels, down about 800,000 head as we look at this July 1st number. Just that's an estimate given what's been placed since January 1st, whenever we did get those numbers. So there could be some room for error there, but generally down to historically low levels there for the outside supply. And carrying this forward to feeder cattle, you can see that that's really helped support prices, but there's been a lot of movement here, and there's a lot of risk and volatility within these markets. So you can see from July to mid-August, you saw a $20 decline to that feeder cattle index. What caused that was mostly due to the move that we saw for the fed cattle, the deferred live cattle markets. So those moved $10 lower. So feeder cattle move lower as well, because putting them on feed and feeding them, there's less profit potential there when the live cattle markets move like that. So there has been a lot of volatility that we've seen within feeder cattle, and as you look, you can see that the feeder cattle are pretty flat as you look at all the contracts out there. And that's not what the seasonal pattern would suggest, but that's just kind of what's been traded due to the fact that the live cattle moved lower. But what we're seeing here lately is we started to see a tick higher. So feeder cattle are starting to move above those averages. And this is another illustration here of a $10 move to live cattle came out to about a $40 move here as we look at the fed cattle, moving from that 260 to 225 for January feeders. So not to hammer this too hard, Austin will get into it more, but as you think about ways to protect risk, to protect against these kinds of moves, that livestock risk management that he's going to talk you through is a great tool to use for whenever you do see prices that are more comfortable. So that those 250s to 260 range, um, protecting those kinds of prices so that if a break like this does happen, is a great way to manage your risk, but also not take away the upside potential that you've got for your cattle. As we look at calves, we've seen a pretty similar move. You saw that move lower in July, softer prices there, but still generally trading at record high levels. Year to date, we're averaging about $50 a hundredweight above what we were seeing last year, but we have come down a lot here in the last month or month and a half. Part of that being the move to the feeder and live cattle futures, but then part of that being that things have dried up some. Pasture conditions might be worsening, as Kirk's going to talk you through, and just a little bit more problems there. But as we think about it, what we've seen the last few years is that if you've been able to retain calves, or if you've been able to do the stocker cattle through the winter grazing program, you've seen quite a bit of profitability here as we look at what we've seen the last few years. So that's got an opportunity to be really profitable, and we would expect to see that again this year. So for those who might have destocked cows due to drought, and if they're seeing improved conditions, it might be a good move this year to do a winter grazing program. I'm sorry, I know I'm running a little bit over, but I'm just about done. So I'm going through some of these kind of quickly, but please feel free to ask any questions. Looking at utility cows, we've again seen record high values here, but trending lower because as we do look, we're getting into more culling season. And so there's just more cows available on the market. And at the same time, ground beef prices are trending lower at the wholesale value. So the ground beef from these cows is worth just a little bit less as we look seasonally through the winter. And so one option there for a producer is to keep these cows and to retain ownership just a little bit longer and then get rid of them in February. What we've seen the last few years is that it's really been profitable to do that. I know there's some carrying costs to those cows, but if you do have a setup where it makes sense to do that with the seasonal trends to the market, where we typically see the lowest price in the fourth quarter and then a pretty good rally here in the first couple months of the year, if you're able to keep these cows, you typically can see some pretty good returns on that by selling them at a time when there's fewer of them on the market. If we look at cow prices in general, those have definitely moved back to a rate where you ought to be retaining heifers, or those that can are retaining heifers. You can see that bred cow price values have moved to record high levels. And then compared to that, the calf price, those prices are also record high. So the value of keeping back cows and then the ability for them to pay for themselves after just a couple of calves that we're seeing has been really strong. But obviously, that can be more limited as you do move in these cycles because you tend to only see a couple years of those really high calf prices. Now, this year being a slower expansion year, we do expect it to be more of a drawn out cycle. So rather than those sharp declines that we saw in the previous cycle, we expect prices to stay more elevated for an extended period of time as we do look to incentivize expansion and continue to see a lot of the profitability passed down through the system. So with the beef prices up at these levels, we ought to see record high fed cattle values, which will lead to record high feeder cattle and calf values as well, just out of the fact that there's tight supply and continued good demand for beef. That's what I've got, Micah. Sorry I ran a little bit over, but I'm going to pass it off to Kirk, and he's going to talk to you all about weather expectations as we look ahead. And again, questions are going to be at the end, but feel free to send those in.
Awesome, Mary. Thank you so much. So I thought it was interesting to see all of those comparisons of how drought and those drier conditions and even some of the recovering conditions have influenced a lot of those markers. So that's one thing I'm going to, as I share my screen here, that's one thing I'm going to really hone in on quite a bit is, especially with this really growing La Nina in this drier just almost spark here in the central United States and growing into the Ohio Valley. Is that going to change? So I am going to make this full screen. And can you guys let me know if you can see it okay real quick?
Yes,
We're
we
good.
can see it.
Perfect, perfect, perfect. Awesome. So that's where we're going to kick things off here. And again, please, please, please ask questions. I want this to be as informative for everybody and appreciate everybody joining in. So this is a look at September month today. And just to stop there real quick, where I'm going with this is I'm going to take our current conditions and I'm going to give us the best outlook as we're going into the fall, as we're going into the winter, but even a little bit further than that, based on some of the recent La Nina progressions of how does that react as we're getting into spring and what are the risks to look for. And same thing as we're going into potentially next summer as well. As I do think, if you take away anything, there is risk. And a lot of these droughts, again, I'm not saying next year is going to be a 100% drought, but this is a major difference versus this time last year. In the entire central United States, almost, especially the Midwest, it's crept into the Ohio Valley and the Great Lakes. Yes, we have, and I'll show you this here in a couple of slides, some tropical moisture to come up. But as soon as that gets out of here, we're right back into this really dry pattern. And I think that's something to really watch as we're going into the winter season is La Ninas don't typically bring really big, robust systems as we're going into the fall and the winter time. So if we're really needing that recharge, that could be a little bit hard to come by. This is a look at the latest soil moisture percentile maps here. And you can see that all of that north central plains and Midwest dryness has expanded pretty significantly. We've had a little bit of relief recently, but Illinois, Indiana, Michigan, Ohio, into northern Kentucky, these have expanded. Now, again, we're going to see a little bit of improvement here in the short term, but the long-term outlook is on the less active side. And I did, because obviously it's a topic of a really big topic right now, I wanted to provide a little bit of an update on now major Hurricane Helene. In fact, I was just looking with our team just about 5 or 10 minutes ago to get a checkup on this, and it's already a mid-category 4. And it hasn't hit landfall yet. So could this thing hit a low end category 5? It's very possible with how warm those waters are. Just the general atmospheric conditions. It's very supportive for a very strong storm as it makes landfall here, probably within the next few hours. So what's crazy is how quickly this storm, as it does makes landfall, it's going to be here across the Ohio Valley tomorrow. And the first impacts that we're going to feel is going to be the wind. So I know a lot of us are located, not all of us, but a lot of us are located in Ohio and Indiana and into Illinois and into Kentucky. We've highlighted an area, the orange, just in case you can't see it, best area for 55-mile-an-hour winds. So 45 to 55-mile-an-hour gusts, sustained winds 20 to 30 mile an hour. In the red area, if you're located in there, 60-plus mile-per-hour winds as we're getting into tomorrow. So definitely alongside of the wind, you can see, and some of this may be a little bit hard to read, but a lot of moisture with a lot of this here as well. We're kind of splitting the 70 corridor here, kind of right in half across the Ohio Valley. But again, some of this could be a little bit too much moisture alongside of that wind the further south that your location is. So it is a robust system. It's going to help temporarily the drier conditions. But here's exactly what I wanted to show you is when we get these tropical systems to work through, it takes away the moisture from anywhere to the west, anywhere to the northwest, anywhere to the west. What's interesting, not saying next week as we're getting into the first but second week of October is going to be equally as dry, but we're already seeing some tropical moisture risks in the south and to the east. That's going to likely rob all of this moisture once again. So I'm really hoping that we cash in on this rain here short term, but the longer term trend, especially with this La Nina deepening, and simply put, that what that means is a less active jet stream, and jet streams are what move the moisture in. And so as we're deepening that, as we go into fall, statistically, we're not really supposed to improve a whole lot. And I was talking with Mary a little bit on the temperatures here right before the webinar here, and here is why we're so dry. Is because when you have an area of really strong ridge, a high pressure across the Intermountain West and the West Central United States, there's no gradient. There's no way for a jet stream to really work in. Now, it's not going to be super warm here in the Ohio Valley, but the consequence of that is there's not a jet stream to kind of point a lot of moisture in these areas. So if we're looking for an improvement outside of in the short term, and here's what I'm also getting at is we're getting into the middle part of October. This has legs. And this is very common of La Ninas is we don't see patterns progress and we don't see them move very much. One of the bigger differences here is now we're anticipating to take that much below normal that's in the central and western United States, kind of place it down across the south. So maybe not as much tropical influence in here. So again, below normal doesn't mean no rain, but statistically, as we're getting into October and November, those are some of our lowest average precipitation months. So here's what I'm getting at. If you can get away a takeaway here for the next 6 weeks, is outside of the short-term moisture, the longer-term trend is we're stuck in this pattern. Yes, the frost freeze risks are on the lower end, but the increased moisture potential, if you're looking for that, I think that's going to be hard to come by. And so here's the meat and potatoes of what I want to get into is, okay, what do we look at as we're looking for seasonal signals as we're getting into the winter time, as we're getting into the spring and summer. The number one atmospheric driver in the oceanic connection is going to be this term that you've heard probably a bunch, but it's called ENSO. That's El Nino Southern Oscillation. It is the way we measure La Nina or El Nino in the oceanic state. And simply put, if you can see my marker here, we're looking at the Central Pacific, the Equatorial Pacific. And what I should have done is showed a comparison versus this time last year, but we were going into a super Nino. And that's the first time it's ever happened on record where we had a strong to super La Nina the season before, and we went right back into a super Nino. And so there's just not a lot of data that you can go by to really compare it. So that's a difference, though, versus as we're going to find ourselves into this coming season, is a lot of our interesting following next years tend to be on the weaker to moderate side of La Nina. In fact, the forecast data is kind of somewhere between a weak to a moderate La Nina. That is interesting because in that territory, please hear me in my thought process when I'm going to say that, but years like 2011 and 2012, those kind of years are from weak ENSO years. There's not a lot of influence from the ocean. And so there's some other similarities with how cold the water is here as I kind of backtrack just right off the west coast here. And that's something that we're watching intently, because if we're cooler with that body of water and we're cooler in the central equatorial Pacific, that means there's not an amped jet stream. There's no moisture tap as it works forward. So again, anticipating this La Nina to grow as we go forward. Again, I know some of this can be hard to read here, but just looking at overall comparable years and what did those years do as we go into October and November and December, you can see they generally all go into this weak La Nina territory here. Half of them go a little bit stronger and the other half kind of meander here. But this tells me that we're going to continue to strengthen this as we go forward, which also tells me, takeaway, that this pattern that I'm going to show you here right now, SON is September, October, November, is rather here to stay. So generally put, some of these years, if they're familiar to you, you can look back on your records and see what those years compared to as we're going deeper into the fall. But 2021, 2017, 2016, 2013, 11, and 05, and 01, a lot of these are since 2000. You can see the general theme is not super active. There's a little bit of a blip of some above normal moisture here. Kind of reminds me of the short-term moisture. But if there's a month out of the next few, and I'm going to show you this right now, where I think there can be a shift, I'm looking at November. And as Mary was kind of talking through her presentation of, talking about droughts and then drought relief and then how things and markers respond to that, if you would to ask me over the next few months, when is there going to be a change? I think it's going to be that November to December timeframe. That's generally in La Ninas as they grow deeper. They're a little bit more active and they're a little bit more volatile. I think the next 4 to 6 weeks are pretty locked in. I think as we get more higher pressure in the south to the east, we get a more active jet stream, which is common as we're getting into the winter. It's called the polar jet stream. It's going to have more of a clash of air masses, and that is when I think we can get some return of some moisture. That's Central Plains, North Central Plains, Midwest, and a little bit more here. I don't think we're talking groundbreaking moisture here, but I think it can be some relief. Now, this is a quick look across the ag belt in general, from west and to the east in terms of the frost and freeze potential. The years tell us, and so does the data. You can see it over the next 2 weeks. It's delayed. In fact, I think we can see a very delayed frost and freeze risk. So could be obviously good for anything that's late planted right now that's continuing to growing. Or just if you're needing the growing season to expand a little bit further off into October, I think that is going to be the case this year. You can see a lot of these are mid to late October in terms of the expected first frost and freeze. So Quickly, not going to spend a lot of time on this as well, but one thing that's interesting, remember I talked about October to November in terms of severe weather. This is interesting. The only reason I'm showing that because of all of us are kind of located across the Great Lakes and into the Ohio Valley and in the Midwest. We typically do see a secondary severe weather season. I think that, again, the typical month for that is into November. And so I think that's going to be the month where I think we can see an increase. A year that comes to mind is 2013, 2017. Both of those years, we saw kind of a secondary severe weather season. So keep that in mind for anything that you're planning, as we go deeper into this fall. This is just a quick breakdown. I'm not going to read every bullet point here, but you can see no major, in terms of the fall, as I quickly move on after this, no major frost freeze risks, mild fall overall, some cold shots, but generally still mild. Plenty of dry stretches for harvest. And just dry stretches in general. I think that's the biggest overall takeaway here as we do go forward. So I think in terms of the temperature pattern that's going to come to change is going to be that November into December. It's tricky. This is going to be and I hate, and I don't want to sound like a cop out because I know it's, could be 50-50 and I'm really trying to give you guys the best possible outlook at what the winter is looking ahead. But there's things to watch. How does this La Nina evolve? Is it more what I'm going to call central base? Is the cooler water in the equatorial Pacific more in that central basin? Or is it more in the east, in the kind of the eastern basin? I can tell you as of right now, if you were to tell me, okay, when you're talking December, January, February, that's DJF, of how is this La Nina looking to respond, I can tell you how it's acting right now. And it's going to be more like the image on the right. That shouldn't be a huge surprise because if we think about our recent winters, what have they not been? They haven't been cold. Maybe minus Mary over there in Denver and Colorado and snowy. We just haven't had that here. If there's a month out of the next few in winter where I think we can see some cold, it's December. But a lot of times in La Ninas, they typically end warm, especially that January and February timeframe. So if we're looking for a snowier part of winter, I think that's December. Here's what I mean by that, by cooler than normal waters and where they're located at in the basin. You can see they're kind of smack dab right in the middle of the screen. It's not on the right side of the screen. It's not on the left side of the screen. It's right in the center here. And again, that is a signal to us. This doesn't really like to change a whole lot as we go deeper into the year, that we're more of that central base, which tells us there's probably more mild risks and less snowy, less moisture risk. Again, remember what we're all relating this back to is there a moisture return ahead as we're getting into fall and wintertime and spring? That would lean less. That would lean less of that. Even for us here across the Ohio Valley, this is a look at our overall analogs here in our official preliminary forecast. I think it's mild. Again, I think we start cold. I think we end on the mild side. That transition likely happens through the first half of January, February, and March. I know we have a lot of folks here from Eastern Indiana, Ohio, Michigan. I think could be a different story there. A lot of these low pressure systems, as they do develop, they get a lot of moisture in a lot of these areas in here. If you're further across to the west, Western Illinois, into Iowa and Wisconsin, Missouri, these kind of locations, I think it's less likely. I think we have more high pressure and drier in these locations here. So it's really kind of split. But one thing I think it is generally mild as we do go forward here. If you're looking for snow, I think we could see some solid lake effect and some systems here in the further east of the Ohio Valley. Into upstate New York and the Northeast there as well. So a couple images I have left here before we kind of go and move on to Austin here. I tried, and so did our team in the last couple of days, to do our best guess, and I hate to use that word, but our best, I would say professional opinion is maybe a better word of what MAM is March, April, May. Okay, guys. So we took a lot of those years as we go into the wintertime, the central based equatorial La Nina. What did those years produce as we get into March, April, May? Here's the thing that should stand out to you, especially on the top images here. We have some models down below just for comparison here, but notice where there isn't a big moisture return is the central United States, the North Central Plains, where we're not seeing it now. Now we do see, and this is typical even in years like 2011 and 2012, and this year before we got really dry. And last year, we see an active spring around Illinois, Indiana, Michigan, Ohio, and Missouri, a lot of these locations, eastern Iowa, Wisconsin, pretty active. But one area where we're looking for it to expand and not really see a lot of return is that Central Plains. And again, when we're thinking about prices and markers and things to look for, that's one thing I'm looking at. JJA is June, July, August. Again, one of the last images that I have here. here's the note: is we think and we anticipate almost like the same pattern as we have right now. That is not a coincidence, guys. These things start now and they translate 6 months from now. And what I'm saying here is, if there was, because of the progression of the La Nina, a more sizable, widespread, longer derived, drier, maybe drought in the central United States, at times bleeding into the eastern Midwest, eastern Ag Belt, Ohio Valley, Great Lakes, that would coincide with the research. And I'm saying that now because this is my last image that I have here of the current conditions and what's going on right now. So just to sum it all up, what's expected ahead? What's the risk here? I think in general, when I see the next 6 to 9 months, it's not full of significant moisture return. I think I would lean more on the risk of less moisture, not as much volatility on the temperatures or big cold outbreaks, big cold snaps, but just not looking at a big moisture return over the next 6 to 9 months here. And that's something to watch very closely. And we're already seeing impacts of that now as we get into next year. So with that, I am going to stop the presentation here, kind of hand it on over to Austin. I look forward to everybody's questions. Please let us know how we can help you out in there. And hopefully that made sense to a lot of everybody.
Awesome. Thanks, Kurt.
Yeah.
Learned a lot from both your presentation and Mary's. That's awesome. Appreciate the information. I'm going to share my screen here and see if I can't manage to screw this up. Micah, can you confirm if you can see my screen, sir?
Sure, we're good.
Cool. Well, thanks everybody. And as Micah mentioned, my name is Austin Robinson. I'm our livestock product specialist, working in Farm Credit Mid-America, covering all four, now part of 5 states that we do business with. So I've got the pleasure of working with cattle producers, like many of you here on the call today. And I want to spend just a few minutes and really the bulk of my time discussing some risk management tools that producers that I and the rest of us here at Farm Credit work with on a daily basis. They're using to help mitigate risk within their operations. So if you're a cattle producer, you don't need me telling you this certainly, but you face a lot of risk. There is many risks, too many to list on a daily basis that you guys run into on a day-to-day basis. And 2 of which, as Mary and Kirk have both pointed out, we've faced this year throughout the crop year is number 1, a decline in market prices. We've seen a really significant drop in both feeder cattle and live cattle markets from the middle of summer till now. Obviously, we still are in good shape historically with elevated prices, but we certainly have seen some market risk this year. And then number 2, the dreaded D word that Kirk alluded to, drought, which we've seen in many areas that we do business in here in Indiana, Ohio, Kentucky, and Tennessee, but really a lack of precipitation. And so we've seen those 2 risks play out in great measure this year. And so 2 of the tools that we're working with producers and helping mitigate some of this risk right now is livestock risk protection, or LRP, as it's often referred to in the marketplace. And livestock risk protection is where I'm going to spend the bulk of my time here this evening discussing. But it is an insurance policy that helps to protect against, it's a market-based insurance product that helps to protect against decline in market prices. And the second tool that a lot of producers are using currently is pasture, rangeland, and forage, or PRF, as it's often referred to in the marketplace. And this allows producers to insure hay or forage acres as part of a hay operation, as well as grazing ground and pasture ground, and ensure that from a lack of precipitation, dry weather, and or drought. And so again, where I'm going to spend the bulk of my time this evening is with LRP, but really we've seen success from both of these tools, producers utilizing these in years like this where we've seen and faced some challenges. So if you've never heard about livestock risk protection, or you may have heard of LRP, you may be asking, what is it? Well, LRP is an insurance policy, and it's what we would call a single peril insurance policy. And it's a market-based risk management product that essentially is going to create a price floor for a group of cattle for a specific period of time. And you may hear a lot of producers or agents, or just really any folks out in the marketplace and the industry, refer to or compare LRP with a put option. And there are a lot of ways in which it's similar to a put option, going out in the open market and buying put contracts. And there are a lot of ways which it's different as well, and some pros and cons to each. But at its basic level, LRP is very similar to a put option in that it's really just creating a price floor for the cattle. And Mary alluded to that in her presentation, as we saw the 250 and 260 range be a good area to protect on the feeder cattle side. But that's essentially what this is doing. And it's similar to row crop insurance policies in that it's a subsidized insurance policy. And I'll kind of get into a little bit what that looks like at the different levels of coverage here in a minute. But at the highest level, it's subsidized at 35%. So the whole idea is to really make it an affordable, cost-effective risk management tool for you as a producer to incorporate into your operation. And so these prices that LRP is going to work off of, prices that you're going to set, prices that you're going to protect, are all going to be based off of the futures market. So if you look at the futures market board, LRP prices for both feeder cattle and live cattle, which we'll get into here in a second, are going to be based off of those prices with some price adjustment factors. And because market futures are a major factor in determining these available coverage prices, LRP is also going to factor in some expected price changes within the market. And so digging into a little bit of the nuts and bolts of LRP, the policy specifically, LRP is available for both feeder cattle and fed cattle. And there are some different types of feeder cattle that this is available for, several different types. Unborn, if you've got pregnant mama cows, heifers, steers, predominantly Brahman, dairy, crossbred, beef on dairy, you name it, it's likely available. And for these different types of cattle, there are some different price adjustment factors that work within the market to adjust prices as what I would call kind of a built-in basis, similar to with the weight classes, to make it more adjustable to what the true value of these animals are in the market. And so feeder cattle is broken down to two different weight categories, anything from 0 or newborn to 600-pound animals. And then anything from 600 to 1,000 pounds would be our weight 1 and our weight 2 categories, respectively. On the fat cattle side, if you are used to have an operation where you're finishing out cattle in a feedlot, steers and heifers are both thrown into the same category there. And that's going to cover anything that's over 1,000 pounds. Really, from an insurability requirement on the fed cattle side, the only major requirements are that the cattle rate at least select or higher and yield with a grade between 1 and 3, which is going to capture the majority of the animals in your feedlot, with the exception of cull cows. Cull cows are not currently insurable under this program, but that is likely changing in the very near future as well. So these coverage prices that we talked about, again, this is a market-based insurance product. The most important thing is it's setting a price floor and locking in a coverage price for you. Again, it's going to vary off of the futures market. So one thing that's really neat about LRP is that you can lock in different prices every single day. Obviously, the futures market is open from 9:30 to 2 o'clock in the afternoon every single day. And so RMA is going to release LRP prices after the market closes. And when the market closes, and generally these prices come out around 4 or 5 o'clock. So that's when they're available to you as the producer, and when I'm working with you as the producer over the phone and via technology in order to lock these prices in that you see favorable in your operation. And so these prices, you're locking in a certain number of head of cattle for a certain number of time, and we would call that an endorsement length. And so the endorsement periods, the time really that you can protect these cattle from a pricing standpoint, from a timing standpoint, I should say, is anywhere as short as a 13-week period and going all the way up to a 52-week period. So going out to this time next year. I mentioned it's a subsidized policy, and you can see in the upper right-hand chart of the screen the different subsidy levels at the different coverage levels. And at that top 95 to 100% price protection, it's subsidized at the 35% level, which is where we see the majority of our producers working in today that we work with. And one of the really neat things I think about LRP is different from some other risk management products is there's no minimum requirements. So you can literally insure as little as 1 head of cattle under an LRP policy, or as many as 12,000 under one endorsement. or 25,000 head a year for both feeder cattle and fed cattle. So it's really a risk management tool that fits any size of operation, no matter how large or how small. So I want to jump into a real life example of what this would look like using today's prices. And before I jump into it, this is a screenshot of Farm Credit's risk analyzer tool, our livestock risk analyzer tool. And this is something that you as a customer have access to. We can set you up with access to this. If you're a livestock customer of ours, if you've got an LRP policy, you can have the same access to this tool that I do. It's the way that is probably the easiest to track prices on a day-to-day basis and set them up to come directly to you, tracking your own endorsements, and actually, if you're so inclined, going into booking your own endorsements as well. So, but this is a real life example using today's closing prices. They were released again about 4:30, I think, is when they hit my inbox this afternoon. So we've got today's date up there, and I've set this up as a feeder cattle weight 2 category going out 13 weeks, the shortest time frame that we can insure right now. So if you're a producer and you call me up and say, hey, I've got a group of 100 head of cattle, I want to look at insuring, the first question I'm going to ask you is, well, when are you thinking about moving these cattle? And if you said, well, around the end of the year, maybe early January, there's a couple of different endorsement links that we could look at, but I would start with the 13-week endorsement. And that would take us out to December 26th. So day after Christmas would be the end date. And I'll come back to the end date in just a minute. The second question that I would ask is, what do you expect these animals to weigh when you do take them to market? And it doesn't have to be perfect, but if it's over that 600-pound range, we fall into that weight 2 category. So if you told me they're going to be around 700 pounds, that's the scenario that we're working off here. And so where did this finish today? Well, 240, 31, 100 weight. This is where the price closed today for steers in the weight 2 category. And if you're a producer that wanted to lock that in today at 100% coverage, you could do so. That would be your price floor, and you would expect to pay $5.26 a hundredweight in premium. And so the premium is important because one of the best things about LRP is you don't pay any premium until it's all said and done. And so the premium is paid after the insurance period is over. So for this example, you're actually going to know how this would shake out before any premium comes due to you as the producer. And so the way that this is set up here is this 240.31 price. We're going to compare that to a 13-week endorsement that's going to end on December 26th. So wherever the market closes at on December 26th, that price on the feeder cattle index is what we're going to compare to this coverage price at 240.31. And if it's below that number by even a penny, this policy is going to start kicking in an indemnity, and it's going to first go down to paying down that premium. And then if it's below your net guarantee, which is just that coverage price with the premium taken out of it, all that money is coming back to you as a producer. So this is not a policy that's designed to make us rich by any means. It's one that's designed similar to crop insurance to make you whole, but really to provide price protection in markets where we see risk. And so that's how this would set up from that standpoint in a real life example. I've got the different coverage levels on here, as many as I could fit on the screen. So going down to 92.5%. Obviously, this goes all the way down to 70, but this is the area that most producers that I'm working with today are sticking in. And so you can say, hey, Austin, 526 a hundredweight, that's a little rich for my blood. I'd like to make it a little bit more affordable. No problem. There are different coverage levels here that we can lock in. I got several producers that fall in this range right here. And so, as you make it more affordable, you do give up some coverage price as well. So there's usually a happy medium or a spot that makes sense for you as a producer, depending on where your break evens are at, what type of levels you're trying to protect. And those are all conversations, that we have over the phone or when I'm on farm with you having that conversation. And so the last thing that I want to share is just really how a scenario would play out in terms of an indemnity. And so we're paying out a lot of claims on LRP right now, as Mary alluded to in her chart. We've taken off a pretty good clip in the markets from middle of July till really the end of August and the levels that we're seeing now. And so this is an example of an indemnity that I've just completed a claim that I just completed for a producer last week. And so this particular producer locked in same weight class that we were with in the other example, steers weight 2. They happen to be taking these animals to 875 pounds. So that's the weight that they locked in. But they locked this in on March 5th, back in March 5th earlier this year, and the coverage price that was available on that day was $269.53. I really wish we could rewind time and go back and get that price. That looks awfully attractive, but that's the price they locked in on March 5th. And on the end date, this was a 26-week endorsement, so it took us out to the beginning of September. And on September 3rd, the market closed on that day at $239.53. So we saw a $30 drop in the market, obviously very significant. This producer had this on for 116 head of cattle, so essentially two semi-loads of cattle. The coverage price, again, the way that this would work from a math standpoint, just so you can see, is you take the coverage price minus the ending value, and we have that $30 drop in the market. So $30 is our per hundredweight indemnity. We multiply that by the target weight at the end date of the contract, which happened to be 875 pounds. And so this producer was paid $262.50 per head on this particular endorsement. Multiply that by 116 head, and the total amount of the indemnity was $30,450. Now, they're not all going to work out this way, but this is just an example of the way that this policy is designed to work when we do have significant market declines, and they don't all have to be significant. But hopefully this gives everyone an idea of just how this scenario would play out. And fortunate enough to be able to add, $30,000 back to this producer's bottom line is the whole reason why we put LRP here in the first place. And as this producer or any producer would tell me, and just as I was tell any of you on the call, this is the worst case scenario, right? I would much rather the market be higher at our end date, sell your cattle at higher prices. You're going to make much more money in that fashion than collecting on insurance. But this is the reason why we put tools like this into place, is to work for producers when they need it the most. And so that's all I have covering LRP. I know we can only cover so much in 10-15 minute time frame, but I've got my contact information on the screen. If you're a producer out there and you'd like to talk about LRP and do a deeper dive into it and how it could work and would work for your operation, the best way to get in contact me is to call my cell phone number, which is on the screen. If you've got a hay operation as part of your cattle operation or grazing ground and you want to talk more about the PRF product, you can certainly reach out to me as well. You can also call your local office. We have insurance officers in every region that we do business in. And so there's a local insurance officer nearby you that's specialized in PRF insurance, and be happy to walk through that as well. So with that, Micah, I'll turn it over back to you. See if we have any questions.
Sure do. Thanks, Austin. I appreciate it. Mary, I'm going to come to you first if you're so kind and willing. The very first question we have here is, what percentage of beef slaughtered does the U.S. import? And with our decreasing cattle numbers, can we expect a pickup in imported beef?
Yeah, that's a great question. So this year we're on track to see a record number of feeder cattle imported from Mexico and Canada. And so that would make up, with what we're seeing, about 9% of our slaughter. And if we look back historically, it's more around 6 to 7% would be a pretty normal range for it. So definitely a larger percent of our slaughter is being imported. But if we think about potential moving forward for further increases to supplement supply, Kirk can probably attest to it, but we've seen, well, Mexico's seen drought as bad or worse than what we have the past several years. So their herd is down, and the same would go for Canada. So they're going to have more limited opportunities to import feeder cattle looking ahead, or it's just going to be tough to continue to increase that for them. If we think about the beef side of things, our beef imports are tracking to be 20% above year-ago levels, and so a record high there as well. But something to remember there is a lot of that is coming in as lean beef imports, so lower value imports, and then at the same time, exports are looking to be steady this year, which is still below our imports number. So net beef trade is going to be a net importer. But if we think about the value of exports going out versus value coming in, we're importing the lean beef, and what we're sending out is going as high value, high quality stuff to resorts in other countries. So imports are definitely going to supplement mostly the loss to the cow slaughter. And then imported feeder cattle is helping to fill the pens, but further growth is kind of limited there, I would say.
Kirk, I want to take it to you next. A question around maybe more of that global perspective that Mary just alluded to. What are we seeing out of Brazil and maybe some of our neighbors to the south, if you will? Are feed costs going to continue to stay down, or are you projecting that they're having a pretty rough year?
Yeah, so last year, just to kind of recap real quick, they had a very, very dry year. Again, that was something that was as note down there, and it's still really dry. And I want to make sure to emphasize that over the next 2 weeks, it is exceptionally warm. It's exceptionally dry across central Brazil. Now, I say that in the same breath that there is a transition likely to happen. We're already kind of seeing the ingredients in the atmosphere that we need to see to make that transition happen going on now. So I'm anticipating around the second to third week of October going forward, probably through the rest of the year, for that Amazonian central Brazil area that's kind of the hub of where we're all focused on, to see rainfall return, those monsoonal rains to be more. That is very indicative of a La Nina. That also means that where is it taking that from? Southern Brazil, Uruguay, especially Argentina. If you look back in any year in the past 10 years, 2017, that's one of the top of our years. It was like a 50-year drought in Argentina. So out of all of South America, I'm not really concerned long-term for Brazil. It would be for operations and interest in Argentina, in southern Brazil, Uruguay, southern Paraguay, those locations. So great question.
Thank you. Mary, back to you. Are the effects of prolonged drought and confinement on beef cow calf concepts in the Corn Belt likely to make materially change how and when the beef cow herd will be rebuilt? And I think Kirk will probably add something on the back end on that front as well.
Yeah, so we kind of talked about that when I looked at the beef cow herd projection looking out. We do see a much slower expansion. And a lot of that was like grazing conditions never got to the really strong levels you need for rapid expansion. And we're seeing that with the heifer numbers as well. So we do expect that to change the way that we grow this time in this cycle. So we do expect to see expansion in the next few years driven by demand and prices, but the rate of that is impacted pretty heavily by the drought conditions that we've seen. And Kirk can talk more about the drought there too.
Yeah. Just quickly to piggyback up on that, and especially that's great analysis too, especially if that's the case. I would anticipate, let's just call it the next 9 months, for that to be more of an expansion than a contraction. This year it was a contraction. We had a lot of moisture, albeit the last 30 days have been kind of record dry, but before that, we've had plenty of moisture. We have not had a decline in moisture, but that is anticipated to grow, could be fairly significant over the next 6 to 9 months.
Mary, politics are alive and well as we head into the election season, and some candidates are talking around potentially freezing grocery store prices. Can you talk to us about maybe the impact, the political impact that you all are keeping an eye on when it comes to the beef industry?
Yeah, and that's a whole can of worms there with the upcoming election, and that's part of the volatility we're seeing. So talk to Austin about some protecting from some of that. But yeah, we look at it as dollars in the system. So if you think of record high retail beef prices that we're seeing, that does kind of carry through the market. So you look, we've seen some really high cutout prices, so wholesale beef values as well. And then that's passed down to fed cattle, which passes down to feeders and calves. So if we were to see a freeze there at kind of the top end, the retail, if you will, that would kind of limit the upside to the beef cutout and then down the chain to cattle as well. So that would definitely be a demand headwind, which wouldn't be demand technically. Consumers might still demand it, but measurably demand would show as much weaker if prices aren't able to move higher.
Austin, I have a producer that just sent in a question. If they're interested enough to bring you out to the farm and maybe go through that, do they have to sign a policy or get in an endorsement on that very first day? What does that process look like to maybe get some of the heads secured?
Sure, great question. The answer is no. You don't have to sign a policy or an endorsement on the very first day, and certainly if you're just open to learning more or interested in learning more about the product and how it could fit for your operation, that's a conversation I'm more than willing to have and have them every day. And what I like to do is to educate folks primarily and hopefully help you protect risk. So the answer is no. You can establish a policy, an LRP policy, to get one open and with us at Farm Credit. That way you do have that costs you nothing to do. But if you have cattle and you think that this might be something you want to put into place when you see more risk in the market or you see the time that you need to take action on it, having an open policy is a no cost way that you can do that through us. So hopefully that helps.
I want to just go around the horn, and Kirk, I'm going to start with you. As we close up tonight, what's the one thing on your mind producers should be thinking about from your perspective?
Yeah, I would say growing drought conditions, maybe not so much at first for the Ohio Valley in the Midwest or Eastern Midwest, Great Lakes, kind of where we're all located. But I think as a whole, if we're standing here maybe 9 to 12 months from now, that'll be what we look back on as, boy, we didn't see a big moisture return. There was more volatility in drought-like conditions or expanded or extended, very dry, less active conditions, as we're going into 25. So I would say that's going to be more of that expansion of that drought, I think, is a higher likelihood.
Mary, what's the one thing you're thinking about producers should be aware of?
I would just say that with the higher prices, there's just more volatility and bigger price swings as well. So, and that goes for grains and that also goes for cattle. So managing risk and being aware of those movements and that just more dollars out there in the system.
Austin, I'll leave it up to you to wrap it up. What's the one thing that you're telling producers as you're out on the farms?
I think Mary hit the nail on the head. That's been my biggest topic of conversation is, talking about the markets. We're still at elevated markets, but obviously very, very volatile, certainly through the summer months until now. And so really, being aware of your break evens, feed costs are low. Hopefully margins are good right now, but being aware of those levels, where they're at and having a risk management plan, whether that's LRP, whether that's options and future strategies, whether that's a combination of both. If you don't have a risk management plan in place, then you're putting your operation at a lot of risk first and foremost, and leaving money on the table as well. So just having the conversation and having a plan.
Austin, one thing I really like that you said is it really doesn't matter how many head you have out in the barn, right? Managing that risk is critical regardless of size or scale of your operation. And so I hope that the producers on the call today are taking that to heart and giving them something to think about as we kind of move on and ever evolving and volatile markets. With that, I just want to say thank you all so much for joining us this evening. This call has been recorded and will be sent out following the webinar. I think it's scheduled to be sent tomorrow morning. And so if you have questions, feel free to respond to that email. We'll get you taken care of. We'll include the slides as well. So if you do have any questions that you would like to kind of look at the graphs again or go through any of these topics with any of our experts on the call, we'd love to be available to you and make sure we get those answered. So with that, thank you all so much for joining us, and we'll see you next time.
Thanks, everybody.
Thank you.